The subject of this video is the sale of a personal residence. This is treated pretty much as if you would treat a stock sale or a bond sale. It's treated as a capital gain. You can look at Pub 4012 at tab D to get more information on this if you run into this. We do see probably a half dozen or so in the course of a season people that have sold their residences, and we need to help them with that. So, also Pub 4491, Lesson 11. So our next slide, lesson topics. We're going to talk about the personal residence and define it. We're also going to define what the word principal means. Principal residence, exclusion, so how much of the gain can be excluded from a principal residence sale, the cost basis of a personal residence, tax layer entries, how we actually put this in the tax layer, and then the comprehensive topics as well, which we're also going to cover. So when we look at the intake and interview sheet, we're going to see a line on there that says income or loss from the sale of stocks, bonds, or real estate, including your home, Forms 1099-S or Form 1099-B. So we may well see a Form 1099-S, but more often than not, we do not see that form, and we'll get into that a little bit later. Exclusion of canceled qualified home mortgage debt income expired 12/31/18 and is out of scope. So the being able to exclude the home mortgage debt expired in 12/31/18 and is now out of scope. It's the canceled debt, by the way. So at one time you used to be able, if you had lost money on your home was underwater, you could have excluded that canceled debt and not have been tax liable for it, but that expired at the end of 2018, and it may well be renewed for 2019, but we really don't know that at this point. Personal residence defined. So this is a residence where the taxpayer lived in it along with their family for a minimum of 15 days during the year. If it was ever rented out or used as in a business, it's out of scope, with one exception, that if it was 14 days or less during the year, then it ends up being tax-free, so we don't really even have to put it on the tax return. So if the taxpayer had somebody renting their home for 14 days or less, it's a freebie. Home is non-investment. Home is a non-investment asset. So part of the personal residence is part of the requirement is that the home has to be a non-investment asset. So capital gain asset would be the gain on the sale, such as like the sale of a stock, or an exclusion of gain depends on two tests, and we're going to get into that. A personal asset cannot be claimed as a loss on a tax return, so if our software comes up with calculating a loss, we need to negate that and make it basically zero gain, zero loss. So here again, gain on principal residence exclusion. You can refer to publication 523, Selling Your Home, because the details are really in that publication, so we're not going to get into great depth on this in this presentation. So publication 523 is your resource that you need to go to for more details. Up to $250,000 gain for a single taxpayer or $500,000 gain for married filing jointly. Must meet both eligibility tests, the ownership test and the use test. The taxpayer must not have excluded gain on any other principal residence within 2 years of the sale of the residence. Principal residence, how do we define that? The principal residence is the main home where the taxpayer lives the majority of time. Can be a house, can be a houseboat, a mobile home, condo, or even a co-op. Must have cooking, sleeping, and bathroom facilities, however. More than one home. Home taxpayers live in, if the taxpayer has more than one home, it has to be the home that the taxpayer lives in most of the time. At least 184 days, including partial days as defined by Massachusetts tax law. Taxpayer cannot simply make the choice that they're going to call their Florida home their main home when in fact they're in Massachusetts more than 6 months out of the year. Eligibility tests for exclusion of gain. During 5 years ending the date of sale, you have to ask these questions. Was it owned for the home for at least, did the taxpayer own the home for at least 2 years? And the use test, lived in a home as a main home for at least 2 years. The 2-year period does not need to necessarily be contiguous. So they can have lived in the home at various times during the year, but if it all adds up to 2 years, then that's fine. So, exclusion of gain on a principal residence. Here's a special rule. Home is still considered the home during short-term absences, even if it was rented out during those absences. But, unfortunately, rental property is out of scope for us, so we're not going to do a tax return for the rental property per se. Exclusion, married taxpayers. So now we're talking about the $500,000 exclusion for married taxpayers. But all of these must apply. The married couple must file a joint return. Either spouse has to meet the ownership test. Both individuals must meet the use test, and neither taxpayer excluded the gain in the 2 prior years before the sale. Otherwise, we can apply the test to see if maybe one spouse qualifies for the $250,000 exclusion, rather than both of them qualifying for the $500,000. Unmarried taxpayers with a jointly owned home may each independently qualify for $250,000. So we do see quite a bit, actually with younger taxpayers, where unmarried people do jointly own a home, but they cannot qualify together for the $500,000 exclusion. They can qualify separately for the $250,000. The reporting the sale of your personal residence. Report on tax return Schedule D if any part of the gain is taxable, or if the taxpayer received Form 1099-S. 1099-S is generated as part of the sale, generally by the closing company or the realtor that is responsible for selling the home. Nor gain or gain less exclusion equaling zero. So if there is no gain on the home, or if there is a gain but there's an exclusion that brings it down to zero, and there is no Form 1099-S, you don't have to report it at all. We're not seeing very much of that these days. These days we are, in fact, seeing 1099-S's. Oftentimes, however, taxpayers are not bringing that form because it really got given to them as part of the closing papers, and so it's buried inside the closing documents in many cases. Other times it does get mailed to the taxpayer independently. In those cases, they have a tendency to bring them in, but more often than not, they don't, and we usually end up sending them home to find that form. We'll ask them, "Did you receive a 1099-S?" They'll usually say, "No, I don't have any recollection of receiving that form." So, but then when they get home and they go look through their papers, they usually find it. So. There are situations, however, I've seen over the years that form really was never generated as part of the closing process, and in that case, you really don't even have to put the sale on the tax return, assuming that the exclusion brings the gain down to zero. If there's still some gain left after the exclusion, then you do still have to put it on the tax return. Okay, sale of other personal residence. If it's not your principal residence, if it's not the main home, then no exclusion is allowed. The gain is taxable on your Schedule D, and the loss is not deductible because it's a personal residence. Anytime there's a personal asset a loss is not deductible. If the residence was previously a rental property, or if it was used for business, such as it had a home office, the taxpayer lived there, they were self-employed, they used part of the home as a home office, and they depreciated that home office each year, that would be out of scope for us. Sale of inherited or gifted home used as a personal reference is, however, in scope if the basis is reported to us by the taxpayer. So we have to have that basis information from the taxpayer. We're not going to just guess at it. Determining cost basis. As we said before, it's the taxpayer's responsibility to provide this information. However, we obviously need the knowledge ourselves as far as what should and should not be considered when determining cost basis. So we begin with the original purchase price of the property. To that, we add fees, expenses paid at the time of purchase, such as legal fees, recording fees, transfer fees, title insurance. And we do not include things like financial fees, homeowner dues, property taxes, rent paid for early occupancy. We do, to the original purchase price, we add improvements that increase the value of the home, such as additions, roofing and siding, and you can refer to Publication 523, Selling Your Home, to get the specifics about what adjustments are usable and not usable. Determining the cost basis. We do not include in cost basis the cost of repairs. Such things such as routine painting, fixing roof leaks, that kind of thing. So we do include the entire roofing job. If you're getting the roof completely replaced, that's an improvement to your property. But fixing a leak in the roof is not. And same thing with painting. However, if you look at the next bullet, we do include repairs done as a part of a larger improvement. So for instance, if a room is added to your home and that requires you to paint the outside of the house, including the newly added room, then that would be an improvement. So improvements that are later replaced, such as you've re-roofed in the amount of time that you've owned your home, you've replaced the roof twice. You can only use the cost of the last roof replacement that can be added to your basis, and not the cost of both of them. So you can review the examples in the NTTC Modified Publication 4012, which you should have access to at this point. Determining gain on the sale. Determining the gain, the amount realized on the sale minus the adjusted cost basis gives you the gain. Taxpayer must provide the sale price and the cost basis information. And you have to remember that inherited or gifted property basis rules apply. And we're going to cover those when we get into the comprehensive section toward the end of this presentation. So here's a little quiz. Can the exclusion of gain be claimed? John purchased a condo in 2004 and lived in it until 2019 when he put it up for sale. Beverly was divorced in 2005 and has lived in her home since then until John and Beverly married in 2018 and began living together in Beverly's home. John sold his condo in 2019 for $300,000 gain. Does John qualify to exclude the gain if married filing jointly? And the answer is ownership test. Yes, he owned since 2004. So here we're applying these tests one at a time. He owned his home since 2004, so he passed the ownership test. The use test, yes, for John, but was not Beverly's main home for 2 of the last 5 years. So John can exclude $250,000 but Beverly cannot. Can these be added to basis? Kitchen remodel? Absolutely. Fixing a leaky pipe? No, because it's a repair, not an improvement. New furnace? Well, this is one we didn't really talk about in earlier slides, but the answer is yes, because that is considered an improvement. Now you've replaced the furnace twice. Are they both included? No. You have to remove the cost of the first and add the cost of the second, and only the second one can be added to the basis value. So let's talk about entering the information into TaxSlayer for the sale of our principal residence. So we have two choices here. We can enter the sale on the Schedule D as if it was a stock sale or a bond sale. And on that same line in the Schedule D, we can claim the exclusion of the gain, assuming the taxpayer qualifies for the exclusion. Or we can also, on that same line, remove the non-deductible loss. So if there's a loss on the sale and it's a personal residence, we have to make that loss be zero. So we can either do that, or we can fill out the TaxSlayer Sale of Home worksheet, which is included within TaxSlayer Online. And there's a tab D on publication 4012 that goes over how to use that worksheet. And we can use the worksheet. It actually works very nicely for detailing the various costs and improvements that would be added to the basis value of the home. And as we plug those numbers in, they will get added to the basis. The nice thing is the worksheet is not required and will not be transmitted to the IRS. So now we're going to get into a video that shows exactly how this is all done. So now we're inside TaxSlayer. We're looking at the Peggy Walker tax return. We're now going to actually enter the sale of her main home. So Peggy Walker was born in 1969, May the 20th. She's filing head of household. She has no spouse. So let's proceed. So we have a couple of different ways that we can enter the sale of her main home on our Schedule D for capital gains. Let's talk about the first of those. And if we go to the federal section, first of all, we have to click on Continue to Leave here. And then we click on the federal section. And if we go to income, we see all the various types of income that we can have, one of them being capital gains and losses. So we're going to click on Begin there. And here again, we have choices under the capital gains. Sale of main home worksheet is one of those. So I could click on Begin to do the sale of home worksheet. But I want to first go through what we would do if we were going to enter the sale of the main home as a regular Schedule D transaction, as if very similar to what we would do if we were entering the sale of a stock or a bond. So let's go into that and take a look at that. So you should already be familiar with entering stocks and bonds on the capital gain worksheet. The only difference being here is instead of the name of a stock, it's going to be perhaps the address of the home that you sold, and then you would put the date acquired, when you originally bought the home, when you sold it, the sale price, and the cost. So your basis, how much your cost was, and how much you sold it for, and any adjustments that you made. So if you had added a room to the house or something like that, you would make the adjustments here. But the main reason I'm on this screen is that I wanted to point out the various codes that can appear on the sale of a capital asset, whether it be a home or a stock or a bond. You see you have a number of different codes. We're going to focus on two of these codes, one being the H code, which excludes some or all of the gain for the sale of a main home, And then we also deal with the L code for the non-deductible loss other than a wash sale. So the L code would be used in a situation where you sold, the taxpayer sold their home and they sold it at a loss, but because it's a personal asset, by law you cannot claim a loss on a personal asset. So we would basically have to zero out that loss and make it a zero gain loss, and we would do that by using code L. So those are the two codes, code H and code L, that apply to the sale of a home. And so that is the way that you could put the transaction in yourself. Of course, you'd have to do all of the math as far as figuring out the adjusted basis of the home. So you start off with maybe, let's say that the home originally cost $150,000. You'd have to add to that the cost of adding an addition to the home, maybe putting a roof on the home, that kind of thing. So it can be done this way, or it can be done using the worksheet. So from here, rather than backing up and selecting the worksheet, I'm going to show you an alternate way of getting at that worksheet. If you look at the taxpayer's name up here, you'll see a little down arrow right beside it. If I click on that, you'll see various selections on here, one of them being a place where you can put notes in the tax return. So if you wanted to put a note about the sale, something like that, you could click on Notes. You have helpful tools. I think one of those tools is actually a calculator, and there are a couple of other tools. I haven't looked at those in a while. But Quick File is what I want to bring your attention to. When you click on Quick File, you have the ability to either put in a form number or a keyword to search for a particular form or a worksheet. So I know this is the sale of home worksheet, so I'm going to type in the word sale. And notice it brings up two things, sales tax paid and the 1099-S, sale of your main home. That's exactly what I want, is sale of my main home. So I'm going to select that, but you'll notice that there's nothing really that shows you that anything happened here when you did that. And if you read the text up above, it tells you that once you enter the form that you want or the worksheet that you want, then you need to click on Continue. So click on Continue, and now you have the sale of home worksheet. So we're going to complete this worksheet. I've got some information here about the date of purchase. Let's say that the date of purchase is May the 8th, 1995. That's when she originally purchased the home. Purchase price was $150,000. The date of sale, we're going to say, is September 8th this year, 2019. And the sale price is $500,000. And since depreciation, which is the next two boxes talk about depreciation, that's out of scope for Tax-Aide. So had there been depreciation involved with this sale, we would have had to have sent the taxpayer away to go to a paid preparer. So we're not going to deal with depreciation. We're going to skip over those two boxes. Information about your home. How many days in the last 5 years was the home your main home? Well, she lived in it for the entire 5 years, so we're going to say that in the 365 times 5 is 1,285. Same thing with how long did you own your home? It's also 1,285. And check here if you received a first-time home buyer's credit and you received it in 2008. That's not the case in her case, so we're going to skip that one. Check here if you qualify for the maximum exclusion or the reduced maximum exclusion. Well, we know that she's single, so her maximum exclusion should be $250,000, but she may qualify for less than that, but we know it's going to be one or the other, so we're going to click that box and click Continue. Here are the adjustments. So fees that you may have paid when you originally bought your home in 1995. So legal fees, we dug out her HUD statement from when she originally purchased the home in 1995, and the HUD statement shows that there were $500 worth of legal fees. There were surveyor fees of $250, title insurance of $200, and there were no other fees, seller fees that she agreed to pay, or any other fees in general. So now we talk about general adjustments. Selling expenses. So for selling expenses, there was primarily the commission that she paid on the sale of the home. She paid $15,000 commission, and the cost of additions and improvements. So she put on a $30,000 addition onto the home in the time that she lived there, and she also replaced the roof a couple of years ago for $10,000. So we're going to say that in all, she put in $40,000 worth of additions to the home. No particular tax assessments for sidewalks, streets, and things like that. Other increases, we had nothing, and no decreases to the basis. So here you can see in this blue area that there is a discussion about the fact that if she had been married and her spouse had passed away, that she would have still qualified for $500,000 exclusion, which is what a married couple would get, even though the spouse had passed away for a period of 2 years after the sale. She could still use that. So, for a period of 2 years after the passing of her spouse, she could still use that $500,000 exclusion if all of these bullet points held true. So, it would have to be within 2 years of the date of sale, 2 years behind, and neither you nor your spouse claimed an exclusion on another home anytime during the last 2 years. You meet the 2-year residence requirement independently of your spouse, and you meet that resident requirement counting your spouse's ownership if you need to. You haven't remarried at the time of the sale. So if all of those things are true, then she could still actually use the $500,000 exclusion if she had been previously married and she lost her spouse within 2 years. So, does she qualify for $500,000 maximum exclusion? Well, the answer is no, because there was no spousal situation. She's a single person. So, let's continue. So, here's the sale of home worksheet. You can see that we did the basic information and we did the adjustments to the sale. So, we will just hit continue to continue. Sale of the home worksheet. We can see that the purchase date, the sold date, September 8th, 2019, purchase price, sale price. You can trash can where you can delete this worksheet, or you can edit the worksheet and make changes to it if you need to, or you can continue, which is what we're going to do. Congratulations. Based on the information that you've entered, you have successfully completed or reviewed the following forms. If you would like to visit additional areas such as income reductions, credits, etc., you may do so at this time. So you can click on any one of these buttons to go to any one of those areas. But we're going to go to the summary. So here we see the summary of our 1040. We're going to go to page 2 to see the capital gains, see if there are any. And sure enough, there's on line 13, capital gain or loss attached to Schedule D. So we show a $44,050 gain. So we know that she didn't sell any stock, she didn't sell any bonds, so that $44,050 must be related to the sale of her home. But we have a lot of questions about that. First of all, why do we have $44,050? And why isn't it zero? So let's take a look at the entire tax return. The summary view only gives us the look at the first 3 pages. We need to look beyond that. So we're going to do a view print return, which actually generates a PDF to the screen. And if we print the PDF, we're going to be able to go through it in detail. And let's go down to Schedule D, capital gains and losses. So this is where you would see any short-term transactions for sale of stocks or bonds. Now we get to long-term transactions, and we see on line 10 a $500,000 proceed with a cost of $190,950, an adjustment of $265,000, which kind of raises the question, why isn't it $250,000? I thought that was the maximum exclusion amount. So we have to track that down and find out what's going on there. And it shows that our gain is actually $44,050, and that would be the taxable gain. So that's going to show, that's what showed up on her Schedule 1 of her 1040. So we can see on Part 3 here that it again shows up $44,050, but we don't see any other information. So we still have a lot of unanswered questions. Now, Schedule D generates, anytime you have a sale on a Schedule D, it generates a Form 8949. You can see that here. So as we go down the 8949, we see main home, description of property, main home. Date acquired, 5/8/95. Date sold, 9/8/2019. Proceeds, $500,000. And the cost, $190,950. And it's Code H. So we looked at Code H when we looked at the long method of putting in the transaction, and we saw the list of codes, so we would have had to pick that from the list and put it into the transaction, whereas the sale of home worksheet automatically determined that it was a Code H. And here you can see the amount of the adjustment, again, $265,000, and we don't really understand why that's not $250,000. So we need to do some more research, so we'll keep on going. And we don't care about any of this, so let's see if we can get down here a little bit faster. And this should be it right here. Okay, adjusted basis of home sold. So we can see on this sheet that the original cost of the home to us was $150,000. We had legal fees, surveyor fees, title insurance, all adding up to $950. Cost of the additions and improvements, $40,000. So our adjusted cost basis for the home is $190,950, which is the number that we've been seeing on all the other forms. So that still doesn't answer the question about the additional $15,000, but this does. The selling price of the home was $500,000. Selling expenses, including commissions, advertising, legal fees, $15,000. So that was the commission that Peggy paid to the realtor when she sold her home back in September. And this is the amount realized, $485,000. Then again, it shows the adjusted basis and the gain or loss. So the gain was $294,050, but she gets a $250,000 exclusion. So that leaves $44,050 that remains to be taxable. So that now answers all of our questions. And I think you can see from this that the worksheet is a much easier way to go. It automatically picks out the code number, the code letter that you need on the 8949. If you were dealing with the loss, I think you would have to enter that on the Schedule D as you would a stock transaction. I don't think you can do the loss on the sale of home worksheet, but I could be wrong on that. I really haven't tested that. So that's it for now, and I appreciate you watching. So for purposes of quality review, we need to make sure that certain things happened after we've gone through this process. We need to verify that the gross amount that was reported on the Form 1099-S matches with what we have on our Schedule D, because the IRS does the matching as well. So IRS receives a copy of this 1099-S, and they fully expect that the tax return that the taxpayer submits is going to show that exact same gross amount. Verify that the basis has been adjusted, and make sure that the appropriate expenses from the original purchase of the home have been added to the basis, and that the expenses of the sale when you sold your home have also been included that would then be added to the exclusion amount. Confirm all tests were met if claiming the exclusion of gain from the sale of home. So the residency test and the home ownership test, both of those tests need to be conducted. Confirm that no losses were claimed on the sale of your personal home. So if it's a personal asset, if it's a personal home, there should be no gain and no loss. Well, there should be no loss, let's put it that way. Now we're going to talk about some comprehensive topics. These get a little more involved, but I think you'll find them very interesting. So the basis for a surviving spouse. So what is the surviving spouse's basis in a property when the spouse has passed away? So the basis in a surviving spouse's hands, assuming the survivor is now the 100% owner. So the property was jointly owned. One of the spouses has passed away. The other spouse inherits the entire property based on how the deed was originally written. Depends on whether separate property or community property. Well, we don't really care about community property in Massachusetts or anywhere in New England, so we're going to kind of ignore that. We're certainly not California, which is a community property state, but we don't even want to deal with that. Legal determination that the taxpayer must provide. Okay, in either case can significantly reduce the gain. So a surviving spouse has a lot of opportunity here in reducing the gain thanks to their deceased spouse. So basis for surviving spouse, here's an example. In a separate property state, as such as Massachusetts, the 100% of the cost is $50,000. 100% of the value on the date of death is $80,000. So a person has died. They originally contributed $50,000 to the property. It's now worth $80,000 when they pass away. So the basis to the survivor is 1/2 of the survivor's half, or $25,000, and 1/2 of the inherited half, which is half of the $80,000. That's $40,000, and that leaves a basis to the survivor of $65,000. So descendants have steps to the value on the date of death. So this is called what's called a stepped-up basis. So the half of the inherited half is the stepped-up basis. So we're not taking half of the deceased spouse's $50,000. We're taking half of what the property is worth when they pass away, which is the $80,000. So again, it's called a stepped-up basis. You'll hear that term used pretty frequently. Now, basis for gifted home. So a home has been gifted to another party, and so what happens here? So 100% of the cost to the donor, this is the person that gave the house away. $50,000 is what the donor originally paid for the property. And then we take 100% of the value on the date that it was gifted. So the date that the deed was written to the new party is the date that the property was gifted to the new party. And 100% of that is $80,000. So the basis is you use the higher of the cost to the donor or the value, whichever is higher. And in this case, of course, the value at the date of the gift is higher, and that becomes the basis in the property. So from that point forward, the new owner of that property uses the $80,000 as a cost basis, and of course, if they do any additions to the property or any improvements, they will add all of those expenses to the basis when they go to sell the property later on. So note that the sale between $50,000 and $80,000 results in no gain or loss. Taxpayer must provide basis. So, in other words, if they inherited the property, if they got the property as a gift on a particular date, and then they immediately sold it, there would be no gain whatsoever. Taxpayer must provide basis, otherwise the sale is out of scope. Special rules for surviving spouse. Unmarried surviving spouse can claim the exclusion of gain up to $500,000. The sale must occur, however, and we had a slide earlier that made reference to this. Sale must occur no later than 2 years after the date of the spouse's death. The married taxpayer conditions were met immediately before the death. So we'll need to enter directly in TaxSlayer. Do not use the worksheet. Interesting. So the worksheet worked very well for us in the example that we did, but apparently when you have a situation that involves a joint ownership within 2 years of one of the spouses passing away, you cannot use the worksheet. So you would have to input that as a regular Schedule D transaction, in which case you'd have to get familiar with the various codes, because we used the code H in our example, but we'd have to look at the codes to see what code applied to this. And it's a little bit different. But this is something that we could very readily see at one of our sites, because we do see a lot of elderly people and a lot of people that have lost their spouses. So this is something you could very well see. Reduced exclusion. Reduced exclusion may be possible if the eligibility test is not met because of a change of employment or unforeseen circumstances such as health. So we looked at a full exclusion of $250,000 for our example, but in a situation such as this, the exclusion could be reduced by some amount. Be aware of reduced exclusion possibility. So returns eligible for reduced exclusion are, in fact, out of scope. So if we can't do the full exclusion, we're not going to do any of it. We're going to put it out of scope and ask the taxpayer to go to a paid preparer. Suspension of the 5-year test period. Special rules for military intelligence and Peace Corps personnel. You can actually get this 5-year requirement excused. But when we don't see that, that would be out of scope for us anyhow. All right, that's it. So that's the sale of home. And as I said, you're going to probably see a few of these in the course of a tax season. And so it would be helpful if you went through this presentation to get the details. So thanks for sticking with me and going through this, and we'll talk to you later.